Deputy Commissioner Hank Webster to chair our deployment committee meeting today. Just wanted to do a quick welcome, a brief introduction. We're going to give a much fuller introduction at the next board meeting in June, but wanted to welcome Hank Webster, our Deputy Commissioner of Energy, who will be taking over for Bureau Chief Vicki Hackett on the board. And Deputy Commissioner Rob Hodeling with the Department of Economic and Community Development, also the Chief Investment Officer there. Welcome to both of you. Again, we'll do a much fuller intro when we get to our board meeting next month. Before I turn it over to Hank, I just wanted to say we've got a really full agenda. We've got 10 resolutions, I think 12 agenda items, including sub-agenda items. So I've informed my team to kind of keep things moving along so that we can work through it. But just wanted to put that out up front. Okay, Hank, I'll turn it to you.
Thanks, Brian, and also welcome to Rob. We're on a kind of a tour of new introductions for everybody, so it's always nice to have a partner in that. Let me start by move pretty expediently by opening up for public comments. So if there are any public comments, please raise your hand, either in person or virtually. And I don't have a great view of everybody. I only have one laptop today, so if there's anybody trying to speak, please let me know.
Great. There are no hands.
All right. Well, then hearing none, we can move on to the next item on the agenda, which is our consent agenda. So Brian, can you please provide a quick overview of the consent agenda?
Excellent. So we have two resolutions on the consent agenda, our meeting minutes from the November meeting of last year. Good afternoon, Dominic. I see you there. And then we've got our energy storage solutions, one project for $734,000 of estimated incentive for a nearly 2 megawatt commercial non-residential battery storage system. So we've got a process in place for staff review and approval and consent agenda item for energy storage solutions. So those are the two resolutions that we have in front of you for the consent agenda. Back to you, Deputy Commissioner.
All right, great. Are there any quick questions on that, or does anybody want to make a motion to approve the consent agenda?
This is Matt. I have a quick question. Brian, could you remind us what's the threshold for staff approval versus board approval on a energy storage? Is it?
Great question. I knew you were going to ask that. Brian, you want to respond there?
It's been a while.
So it's up to $500,000 per project.
So why is this on the consent agenda and not an individual item?
So the staff can approve up to 500,000. If it's greater than 500,000, then the deployment committee would have to approve it per the consent agenda. I think that's the process.
So if it's a staff approval under 500,000, it doesn't even go forward with a consent resolution. It just the queue gets cleared with a report out of the material into the folder. If it's over 500,000, but there's no wrinkles to the project, we just throw it on the consent agenda.
Right, and then we get a report of the staff activity. But I thought if it was over, I thought it would be an individual agenda item where we'd get the information about the project. It's fine. I don't mind if the other members don't mind. I just wanted to, for some reason, I feel like it's been a while. If it's under, we'll get an update, right? Staff did the following transactions. And if it's over, we vote on it. But I didn't realize it would go to the consent agenda. That's fine with me. I mean, I just wanted to make sure I was clear on the procedure. I'm happy to move the motion if no one else has any questions.
Hey, Matt, real quick, this is Sergio Carrillo. So as part of the package, you should have received the project authorization form, the PAF, that where we get the approvals, as well as the tear sheet that provide highlights on the project, the amount,
in-
you know,
in
how
bo-
it's
in
being
board
used,
effect.
etc. Yep.
Yeah, in board effect. Yep. Yeah. Oh, I agree. Thank you.
Thanks.
Are there any other questions before we take the motion from Matt and then ask for a second? Any more discussion or questions? All right, hearing none. Is there a second on the motion?
This is Lonnie. I second.
Okay. And all those in favor say aye or
Aye.
nay?
Aye.
Okay. All right. Any nays? Any abstentions?
This is Bettina. I'm going to abstain because I was not a board member in November. Thank you.
Thank you. All right. Does the team have everything it needs for recording before we move on?
We're all set.
Okay,
Thank you.
excellent. All right, moving to our next agenda item. We will have an update on financing programs and some recommendations. And so I want to invite Mackie and his team to present.
Great. Thank you, Commissioner. So we've got a number of CPACE transactions here. Myself and Elise Guzzelli will sort of tag team on these. We are going to try to balance the fact that for a couple of you, these are the first CPACE transactions you've seen with the fact that we don't have a lot of time and a lot of transactions. So forgive me, I'll try to speed through those, but interrupt or feel free to dig in any pieces necessary. So this first project in Bridgeport is at the Colby Cathedral High School. This is the first of another series of projects that we're doing in the Diocese of Bridgeport. At least Matt, I'm sure will remember that we in the past have done several projects with them. They have another small portfolio they're bringing to us that have Xerox. And this is the first that we're closing on with them. So they'll be receiving, as I mentioned, they have Xerox. It's a solar PV system along with roof upgrades and electrical system upgrades. We modeled this conservative. I can go to the next slide. There you see the financial metrics. We modeled this somewhat conservatively on the SIR side. We assumed a 30% ITC. This is a nonprofit, as you might imagine, and they will be taking advantage of the new ability for direct pay of the ITC thanks to the Inflation Reduction Act. They are in a low-income eligible community, so will be eligible for a 10%, at least a 10% adder. However, there's an application process for that we will intend to help them get through, hopefully access that money, which will improve the overall economics of this project. But we were conservative with the 30% estimate here. Next slide. Skip this and go on to the project details. Why don't I turn it over to David Beach, who did the underwriting on this, for just a quick summary of that.
Thanks, Mackie. Yeah, we'll try to be quick as I know we have a lot to get through. For this project, we just looked at a couple things. The finance team calculated a debt service coverage ratio of about 2.7x. That's an average of the 20-year term for the CPACE assessment. And we got to that number by projecting a net operating income in 2023 for the school, using an average of the past 3 years of the school's EBITDA, which stands for earnings before income taxation, depreciation, and amortization. One other thing involved in this underwriting is that the school has what's called a beneficial interest in the Foundations in Education, which is an endowment fund owned by the Bridgeport Diocese that is used to support Catholic education. So we had a chance to take a look at the part of that endowment that the school has an interest in, to see what is possible for them to potentially rely on if they ever needed to pull distributions in case they had years where they weren't able to generate an operating profit. I'll be around at the end of each one of these CPACE presentations to answer any questions if there are any. With that, I'll hand it back to Mackie.
Yep, and that's really it. Are there any questions on this one?
Yeah, this is Bettina. I thought I heard you say the coverage was 2.7, but this sheet says 4.3. Either one's great.
Yep, that's I was wondered if I should point that out. You caught it. So that's actually that the 4.3 is for the school itself, who is going to be paying the bills. However, the property is owned by the Cathedral Parish and their DSCR. So technically that, since they're the property owning entity, that's who our primary borrower is. CPACE assessment is a lien on the property.
Okay.
So their DSCR is the David, correct me if I'm wrong here, but their DSCR is the 2.7, but really it's the school that's going to be transferring the money to the parish in order to pay us, since they are going to realize the electric savings since they actually operate the property. So their DSCR is 4.3.
Yeah,
Okay.
that's right, Mackie. Yeah, we often calculate a couple different ones. Operating company, the property owner, if they're different, and sometimes we look at if we ever had to potentially take over the property and rent it out, what sort of income would we be able to generate, and how would that cover the CPACE cost? So if you ever see sometimes conflicting debt service coverage ratios, that's what they are. But I'll try to make sure I'm presenting the same one that's on the board slide.
Okay,
It's
well,
on
they're
on the
both
tear
very
sheet.
they're both very healthy, so I'm fine
Yeah.
with that. No problem.
Any other questions on resolution 3? Okay, do I have a motion to approve resolution 3?
This is Bettina. I'll move it.
Thank you. Is there a second?
Second, Matt.
Okay. All those in favor say aye.
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 Any nays? Okay, thank you. Any nays? Any abstentions? All right, thank you. Motion is approved. Mackie, can you walk us through resolution 4?
I'm going to turn it over to Elise for this one.
Thank you.
All right, great. Thanks, Mackie. Afternoon, everybody. So this project is for Air Realty Group in Barkhamsted. They are a manufacturer of machine parts for the aerospace and defense industry. So we're looking to do just under $1 million project for roof replacement, as well as a solar PV installation. The main driver for this project was around the roof. So they were trying to maximize the amount that they could finance for their roof, as well as the solar PV system. So a really good example of a cost that solar PV was able to make even better. This project is also getting an Energy on the Line grant. Energy on the Line is a grant program that we've been working with DECD on. So they will be getting a $40,000 grant, which comes right off the top of their project cost. So they don't need to finance that with us. They get that directly. Next slide, please. So the loan and lien to value here, I think David will talk about when we get to the tear sheet slide in a few seconds. So I think we can go to the next slide. Maybe one more. Sorry, thanks, Brian. There we go. So David, if you could quickly give some background on the underwriting for this project, that'd be great.
Thank you, Elise. I appreciate it. Yeah, so for this project, we also turns out to be shockingly similar debt service coverage ratio at about 2.7%. That was also, once again, calculating using the company's last 3 years of EBITDA. We also took extra care to look at the company's liabilities. They have some debt with Webster Bank, including a $5.9 million term loan and a revolving credit facility, which they can draw against up to about $13 million. These loans are secured by substantially all of the company's assets. And so you may have noticed on the memo, we are still trying to dig deep into these loan agreements to understand if mortgage consent is needed. They do not show up on the title search. So at this point, we're not quite sure, but think we're probably likely good to go on lender consent, but still have to dig down a little bit deeper. You'll see the loan to value looks honestly shockingly high here. But what we looked at to sort of put this into perspective is that the company at large not only has this facility in Barkhamsted, but another large facility in Long Island. And so when we actually sort of apportion out the term loan from Webster Bank, and based on, you know, the full property and equipment of the company, and the percentage that of that total that is for this property in Barkhamsted, and then take that same percentage of the term loan and apply it to this actual property. The loan to value is closer to 90%, and that's probably a conservative sort of allocation. So the loan to value on the screen here is a little misleading. And so diving deeper into some of these things, we're comfortable that the company has plenty of assets, and each one of these loans is in a good space in terms of collateralization. And the inclusion of the C-PACE loan in the mix with these Webster Bank loans has a very small impact on the debt service coverage ratio. I think it drops from something like 2.7% down to like 2.6%. So that's kind of how we get comfortable. Happy to answer questions. I know this is a bit of a unique underwriting, but that's a little taste of how we got comfortable.
This is Lonnie. Just quickly, I know we've always had a good relationship with Webster Bank. So do we interact with them? I mean, do we dive deeper with them in terms of doing a deal like this to get their sense of confidence?
I don't think we're at that point as of yet. We'll dive in if we find out we need lender consent. I think right now, and I guess Elise can probably comment on this a little bit better, we're letting the company kind of manage their relationship with the bank. But we'll certainly dive in if we find lender consent is needed.
I mean, it just feels like, given all that's going on in banking now, it'd be good to go that extra mile. Thanks.
Agreed.
Yeah, I just to step in for a moment, Madam Chair. Yeah, it's a tricky situation. Mackie, you might actually want to weigh in, but we tend to stay on the sidelines when it comes to discussions between our customer and their lender, unless it's absolutely necessary that we kind of enter into that discussion. Some customers are quite particular about how they manage their banking relationships with their relationship officers. So it's something that we will consider, but generally, unless there is a consent issue, we're going to stay on the sidelines. I don't know, Mackie, you want to weigh in on that?
Yeah, that's right. And even when there is a consent issue, I mean, honestly, we prefer to be the lead on having the conversation with the bank, just because we understand C-PACE and how to have that conversation about consent typically better than a borrower. However, as Bert said, most of a lot of them value and want to maintain that direct relationship and discussions with their banker. So we always follow our borrower's lead in terms of how that conversation plays out.
Just a quick public policy note for our new board members. C-PACE passed in 2013 on a bipartisan basis, probably a nearly unanimous bipartisan basis. One of the key provisions that enabled that was lender consent, that the existing mortgage holder would have to consent to our C-PACE benefit assessment being senior to their existing mortgage. When that happened and got built into the law, everybody came on board and backed the CPACE policy in 2013. So it's a key thing. And we've had what, gang, probably, I don't know, more than 50 financial institutions consent.
That's right. Yep. Just north of that.
But I had a question about the cash flow for this project. Could you talk a little bit about it? It seems, well, if I'm reading it right, to have a lot of negative cash flow years.
Yeah, I think in this particular instance, the main driver was to try to get as much CPACE financing as they could. We since our last board meeting, we and what we discussed there, and wanting to make sure that our borrowers are well aware of options that they have, and what we could do to structure their repayments to align better with their cash flows. We've had a lot of conversations with our borrowers since then to try to make them aware of that. This particular company, we have not had that conversation with them yet, and that was just due to timing of trying to get this project in front of you all. But it's certainly something that we will be having a conversation with them when we move on to next steps, to make sure that they're aware that we can structure it to make it look a little bit more attractive in terms of cash flows. But I think the main driver was not so much positive cash flow on a yearly basis, but more, to try to utilize the CPACE financing as much as they could with a positive savings to investment ratio.
Yeah, well, thanks. I think in this cash flow looks even more worrying to me than the one that I originally commented on at the last meeting where we had the discussion. So I would encourage you to have that conversation with them. I know you will, but maybe I'll go a little further than I went in the last time we discussed this, because I've been thinking about it. I think we have a sort of programmatic obligation to look at this as well. I mean, yes, we should talk to our client and customer and explain to them that the out years, they're going to be, year over year paying more for this system than they're going to be getting in savings. And they may decide to go ahead anyway because the cash flow in year one is so attractive. They've maximized it. And the way that CPACE is structured, the debt doesn't accelerate when they sell or transfer later on, although a buyer obviously could take it into account. But I just think, I just think you can hear in the future a bunch of businesses complaining about how this program was a negative experience for them, because even though they had all this money up front and maybe they didn't use it wisely, et cetera, what the headline is going to be all the cash flow negative years. So I think we do want to counsel our customers, but I think we should have a discussion at some point, if others agree, about whether just as a green bank, there's a limit to how cash flow negative we're willing to allow a project to be. And the answer may be it's not our concern, but I think it's something worth talking about.
Is there a way we can sculpt the debt service so that it becomes more balanced?
Yeah, that
pay
is
more
something.
upfront and less in the back end so that we don't have that dis savings?
Yeah, that is kind of the offer that we'll make, and it's similar to essentially how one of the offerings we're doing for nonprofits, essentially allowing them to pay a large payment as their second or third payment when they receive the investment tax credit. So it's a large payment that sort of matches with the large initial cash flow that you see on the savings to investment ratio chart. And that way, that large payment matches those tax benefits with smaller payments in the out years, to at least much more closely align. Even if not all the extra cash flow years we can get perfectly positive every time, at least they're much closer than some of these large years where it's losing significantly negative cash flows for a long period of years. That is something that we will offer. Yeah, and that's how it works.
Yeah, and Bettina, if you don't have Board Effect open, this project, if I'm reading it right, is cash flow negatives every year, starting in year 2.
I
Except-
don't have it open. Thank you for the for the reminder. Let me do that right now.
Yeah, we are, I'm sorry, Director Riddell, I didn't mean to cut you off. You want to go on?
No, that's it. I'm done.
Yeah, what we informally called the Matt Rinelli option internally. We are we're making sure in every borrow conversation where this occurs that we're offering this exactly the sculpted amortization option that was mentioned. But I mean, we have been just making it an option, which, in many cases, especially now that NRES, the solar program is getting more and more competitive and driving down the tariff prices. I think this is going to become more and more common where you see negative, you get the huge upfront ITC and tax benefits, and then in many of the out years, you're negative. So we'll offer the option of essentially us grabbing a big piece of that upfront ITC so that the latter years you don't see those. But I think many borrowers think they could, they'd rather have that money in their pockets, and they could probably do better than, they'd rather keep it and get a higher rate of return than our interest, than pay down our principal, given our very reasonable rates. So yeah, Director Rinelli, we should have that discussion. I mean, I feel, these loans are within the what the statute allows, and we are really the only lender serving this market. So I just think we need to be careful about how much of a sort of limiting approach we want to take on what is, for the most part, sophisticated borrowers who understand what they're walking into and feel like they can do better with the money than.
Yeah, I agree, Mackie. This is what the program says. There's no doubt about it. I just worry that there'll be a crush in the out years where people say, this prevents the business. It's a negative drag on business, and it'll give give the whole space a black eye.
I do want to point out that if we determine in the underwriting process that the borrower is put at risk from a cash flow coverage perspective, during those negative periods, then we're not going to qualify that borrower for being able to do this. So it's part of the underwriting consideration. Just want to let you know, Matt.
Yep. And I know we got a big agenda. I'm happy to take it offline, but I just wanted to flag it. I noticed this, and a couple of the upcoming projects are similar, so I won't comment on those.
Yeah, like I said, I think NRES is going to force this to happen more and more, because those numbers, I mean, Matt, you work in this market, you hear a lot of complaints from developers, they're getting very low.
Yep.
You all read my mind. I think this was a good topic to mine, and I would encourage us to take it offline, maybe even roll it into the next full board meeting if it can't be resolved otherwise, but appreciate the feedback and the questions. If there are no other questions on this particular resolution number 4, is there a motion to approve?
So moved, Matt.
And a second?
Bettina, I'll second.
All those in favor, please say aye.
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 Any nays? And any abstentions? All right. Thank you very much. Moving on, resolution number 5, back to Mackie and team. Thank you.
Okay, thank you. So now moving on to Bead Industries. This building actually straddles 2 municipalities, which is very interesting. That doesn't happen that often, but the building is literally partially in Orange and partially in Milford. So Bead Industries is a manufacturing company of, believe it or not, beaded chains. And they also do some electric circuit board manufacturing as well. So they're looking to do rooftop solar PV project and a roof replacement as well for about $700,000. So I think we can skip right to the tear sheet and let David chat about. Yep, there we go. The underwriting.
Thanks, Elise. Yeah, Beat Industries, they have been consistently profitable over the years that we reviewed. In addition to actually having the manufacturing of metal beaded chain, like Elise mentioned, the company also wholly owns a subsidiary called McGuire Manufacturing that actually distributes commercial plumbing products. And if you had a chance to read through the underwriting memo, we saw that we looked into both the profitability of both these subsidiaries and actually how the company as a whole has been the past few years relying more on the distribution company, McGuire Manufacturing, than the beaded chain side of the business. Though with some recent improvements on that side, both business units are now profitable. So the debt service coverage you see on the screen, we looked at what sort of income we would expect if we ever needed to rent out this building. So that provided a debt service coverage of 3.25. But when we looked at the profitability of the company as a whole, the debt service coverage is significantly higher. It's at 27x. And that's looking again at the past couple of years of the company's EBITDA. So quite a strong underwriting here. And I'll pass it back to Elise.
Great, thank you. Yep, and just to point out, we are having a similar conversation with the folks at Bead next week. We're looking to schedule a call with David and their accounting team, specifically to talk about cash flows and how our repayment will look for their cash flows. So we will be looking to schedule that with them next week. And that wraps this one up.
All right, thank you, Elise. Matt, any questions from the deployment committee? All right, then in that case, is there a motion to approve?
So moved, Matt.
Bettina
second?
second.
Okay.
Bettina second.
All those in favor, please say aye.
Aye. Aye. Aye.
Aye.
Aye.
Any opposed? Any abstentions? All right, thank you. So moved. Resolution number 6. Back to the team.
Great, I think I will take this one. Next slide, we got yet another solar project on a manufacturer. This is a 185 kilowatt system at Cologne Industries. This is a sort of specialty coating services they provide to the aerospace industry. Been around since 1982. This is our first solar project with an efficiency contractor, ESC, that we've worked with for a few years now. They did the large project at the Mystic Aquarium. This is our first solar project with them, so it's great to see them moving into the solar space. Let's skip ahead to the tear sheet, and I'll turn it over to David.
Thanks, Mackie. Yeah, so as Mackie mentioned, this property is owned by Cologne Industries. The debt service coverage you see on the screen, the 3.06, we took that by looking at the private appraisal that was done back in 2022. And in that private appraisal, they have something called the income capitalization approach, where the appraisal company will look at how the building would be able to generate income via renting it out to tenants. And so we took their estimated income for the building and compared that to the CPACE payments and the debt for the company and got that debt service coverage ratio. We also calculated a debt service coverage of 4.7x, which we got to that number by, again, like in previous underwritings, taking the past few years of the company's EBITDA and projecting that out to 2023. This company, like many we've seen in the aerospace industry in Connecticut, did face some difficulties in 2020 and 2021 as a result of the pandemic and how that affected the aerospace industry. They were, however, able to maintain profitability throughout the those few years, and are now on track to return to a sales level that is similar to what it was prior to the pandemic. So we're quite confident with this underwriting. I'll pass it back. Thank you.
Great. And I'll point out one interesting thing here on going back to the cash flow issue. I mean, if you'll look at this one, it's much better. And what's different here is the fact that there's not a roof included, right? I mean, we have a lot of borrowers that just, I mean, yeah, solar's nice, but 20-year financing on a new roof is great. So it's not so much the solar savings and cash flow that's driving it, but getting a new roof and using the solar savings to pay for most of it. So two different motivations that drive very different sort of project economics. When you're maximizing the CPACE financing, driving that SIR right to 1, it's hard to get to economics that, or a cash flow that we think looks good. Whereas you're just doing solar like this, you still can look sort of more attractive from a typical standpoint.
All right, thank you. Any questions from the committee? All right, then is there a motion to approve?
Matt, so moved.
Bettina, second.
We'll switch next time, Bettina.
Okay, I was gonna jump in,
I don't know.
preempt you, but you're too quick.
It's working pretty smoothly. So all those in favor?
Aye.
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 Any opposed? Any abstentions? All right, the motion carries. Resolution number 7.
Okay, back to me for this one. I think this is our last one. So this is for Holy Cross High School in Waterbury, a private high school, probably pretty familiar to those who've been in Connecticut for a while. They're looking to do a solar PV project roof replacement, but they're also doing some efficiency work, some lighting, building management system, and controls as well. So nice comprehensive project here for about 1.5 million. This project actually came to us originally for just efficiency. They were going to maybe do a PPA for the solar if it worked out. But then the Inflation Reduction Act happened, and they were able to look at this from an ownership perspective and actually own the solar PV. So really bumped up the total amount that they're looking to finance with us, which is great. We love comprehensive projects. All right, and on to the tear sheet for David.
Thanks, Elise. So for this project, similar to others you've heard, we looked at the school's past 3 years EBITDA, took an average of that and projected it as the 2023 net operating income and kept that level the same over the next 20 years. And that created then an average debt service coverage ratio of what you see on the screen, 2.38. Similar to the Colby Cathedral High School you saw earlier, we also took a look at the school's endowment, despite some of the market volatility and the school taking some larger than usual distributions in 2020 and 2021 to help maintain liquidity. That endowment value has actually risen over the past few years and is an extra layer of security that the school can rely on if they ever happen to have a situation where profitability struggles for whatever reason. So that's how we got comfortable with this project. And for the last time, I will pass it back to Elise and Mackie. Thank you.
Thanks, David. Yep, and just the last thing to mention for this one as well, because it's a nonprofit, we were already kind of having the conversation with them around a sculpted repayment schedule and having that repayment upfront or earlier with when they got their direct pay. We will continue to have that conversation with them and work with them on a sculpted amortization repayment schedule if they'd like to do that. And that's it.
All right, thank you. Any questions from the committee?
Yeah, this is Bettina. Just this isn't critical, but I was curious about timing. School, is there an urgency to get this done over the summer while the school's out of session? Any,
That's
I
a
don't know if
really good
that's a-
question. I do think that they are looking to move forward with the efficiency work, likely over the summer. The solar, I think, is a little bit less important to have done while school is not in session, but I do think they are looking to work on the interior work over the summer. So hoping to get things closed up for them soon.
Any other questions from the committee? All right. Is there a motion to approve?
Yeah, Bettina, so moved.
And a second?
Matt, second.
Okay, look at that. All in favor?
Aye.
Aye.
Any opposed? Any abstentions? All right, thank you. So moved. Now we'll turn it over to Mariana and Brian to discuss St. John's Church and a write-off approval, which is item F in the agenda and will lead to resolution 8.
All right, thank you, Mariana.
Thank you. I'll take that away. This is Mariana Tree from the investments. I'm from the investments team at the Green Bank. If you could show the next slide. So this is a PPA project that's owned by the Green Bank through CT Solar Lease 3. It was installed back in 2017. And the customer is sort of fully current. We're coming here to do a write-off that is not due to non-payment. Sorry for the typo there. It should say this is not due to non-payment, but rather to damages. If you can go to the next slide. In a recent PMI, we suspected squirrel damage across the installation, the solar PV installation, the rooftop. So we did further digging, removed some panels, and as you can see here, there's basically chewed up wires and connectors throughout the arrays, both the upper portion and the lower portion of the roof. And as advised by our O&M provider, this is a potential fire hazard, so it required some action with urgency. If we go to the next slide. So we're coming here with sort of the proposal to write off the project. The cost to restore and reinstall the solar at the time was $98,000, and probably didn't mention this to the start, but the cost to install the solar to begin with was about $100,000 back in 2017. And the reason why it's so cost to restore and reinstall is because of that really high and tilted steep pitched upper roof, which requires a lift that's expensive, and they have to bring the lift up and down every time they remove a panel. So it's quite costly. And in addition, maintaining that upper roof, even if everything were to be repaired and reinstalled, is quite costly if there were to be any other potential damage in the future from squirrels or from anything else. So we're coming here to request a write-off in an amount of $155,000. That includes the sort of the foregone PPA plus ZREC revenue left in the project, along with the cost to remove the system, which was about $49,000, so about half of the cost to restore and reinstall the solar. We also sort of have reason to believe that some of the equipment, being panels, racking, inverters, can be used in other sites, and that could eventually reduce the write-off amount, although we're not including that in the calculation. And the way we're sort of mitigating this for future installations is we're requiring the use of squirrel guards for all installations that could potentially be owned by the Green Bank, and just providing additional technical diligence for difficult to maintain roofs like this one, given sort of the height and the pitch. So that's
Has this
it with
happened
that.
before in other, I'm sorry, this is Bettina. Has this, I mean, is this like a common occurrence with squirrels, or is this really, really rare? And is there insurance that could cover this?
All great questions. So it's not uncommon. We have sort of gone back to install squirrel guards in some roofs where there has been damage, or where there could be damage. I think what's unusual about this one installation, or what makes it different from the others, is that the cost to do those repairs and restoration is really expensive because of sort of the tilt of that roof and how high up it is, and so it requires sort of further lifts. Going back to your question about insurance sort of does not cover damage by squirrels, unfortunately. But
And I asked
But
that same question.
yes, Brian prepared us for this question. Yeah.
So one follow-up, I'm sorry, because she asked the exact same questions and I'm new to this, but you mentioned use of squirrel guards for all installations. So all the other ones we just passed earlier would all have the same squirrel guards on them?
So I this is a requirement that we're making for projects that we own, that the Green Bank owns. The Green Bank owns this project and has had a power purchase agreement with a customer. It's a consideration that we should think about for others where we're lending against, but currently it's just for the ones that we own ourselves.
Got it.
But there's hundreds of projects that you've approved over the years. I mean, what happens if, I don't know, I'm making this up, like 10% of them have squirrel damage? I mean, what's that gonna do for the loan payments?
Yeah,
Risk,
this is cropped up from time to time, even on our residential portfolio.
Yeah.
And so it's one of those things where at the time, once you're installing a system, it's relatively and this comes from the progressive amount of experience that we've gotten with these projects over the years. It's a relatively inexpensive item to add at the time of installation. It's going back and retrofitting is a much more costly endeavor, because now you got to roll a truck, and you've got to hire two guys, and they've got to go up, and they're going up and down and everything else. So we've taken the position of not saying we're going to go back and retrofit everything that we own. It would just be cost prohibitive. But these systems are looked at periodically, so we just make sure that they're spotted, particularly on the commercial side. We have a very regular process of looking at the system. So if there's anything that kind of looks problematic, we would do a retrofit in that case.
These are all really good questions. I don't think it's a tough nut to crack. But I want to keep us on track too. So, separating, this particular approval of this resolution and a fuller squirrel related discussion, because I think everybody's asking the right questions. How big of a problem is this? How are we going to protect against it? I think that's another item that we can maybe pull out for a fuller discussion, either with the board or with staff at a later date. So I just want to keep us on track. If there are any other questions particular to this write-off resolution.
So I have a question. The loan loss decision framework. I tried to go back and find it, but all I could find were the slides. Are there any findings that we're supposed to make, or factors we're supposed to consider as part of that framework? I know they said there was a memo from 2018, or is it just staff presents the evaluation, and if we agree, we go forward? I just can't remember what we said were the criteria.
Brian, you have that?
Yeah, I don't think we set forth specific criteria, and we're trying. I think from a staff perspective, based on the amount of the write-off and the situation, we provide more or less detail accordingly. I mean, for this one was pretty straightforward. And if they get more complicated with third parties, we'd obviously provide more details. But there isn't like a set these are the 6 criteria that we show. We left it somewhat open.
Okay. Yeah, I just couldn't remember, and I wanted to make sure if we had to make a finding, we made it, but
Great question. Any other questions related to this write-off and resolution number 8? Hearing none, is there a motion to approve?
This is Bettina, so moved.
And a
Matt,
second?
second.
All right, all in
I was
favor?
gonna second.
Aye.
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 Any opposed? Any abstentions? All right, hearing none, I'd like to move on to the next item, which is an update on the CPACE resilience. And that's from Elise.
Great, thank you. So just really quickly, I'll give a quick background for some of the new folks here. So the CPACE statute, oh gosh, now you're going to test it. I think it was 2011 or maybe 2012 that this was originally passed. But in 2022, last session, we were able to make a change to the statute to exempt resilience measures as well as EV charging infrastructure measures from the savings to investment ratio requirement that is in place for clean energy measures. So we are now working on putting together some guidelines for resilience projects that might want to use CPACE to finance them. So what you're seeing here on the screen, the first paragraph up there is just the definition of resilience. So you can see it's pretty broad. It's focusing here on the impacts of climate change, but it's specific here that it's saying it's including but not limited to. So there's lots of different things that could be included in this definition. So that when you have a really broad definition like that, certainly makes for an interesting challenge when you're trying to develop guidelines around that. So these are some of the other requirements that were in the statute that the Green Bank will work with DEEP as well as CIRCA to develop these guidelines. And Director Webster's been on some of our calls that we've had with DEEP around this conversation. And then the other requirement, while it's exempt from the SIR, it is still required to, our resilience projects are still required to provide a resilience study, which assesses the expected energy resilience cost savings associated with the project. So that's a little bit of the background on kind of where we're starting with putting these guidelines together. So on the next slide here, just giving you kind of a high level view of our approach. So this is a little bit of a teaser. You'll see this again, I think, in our June board meeting if we've got time. But we will eventually be coming to you all with a firm set of guidelines. But really our approach is to understand the need for resilience financing for commercial properties in Connecticut. And we're doing that by structuring these guidelines to identify some of the common climate change adaptation measures that we see in Connecticut. Examples are here, worked with DEEP and CIRCA to kind of put this list together. And then also to make sure that we're indicating within our guidelines how other resilience measures that maybe fall outside of climate change adaptation could be reviewed or accepted, and also collecting just general data, market data, information, intel from some of the leads and folks that are interested in using this, and then, continuing to adapt these guidelines accordingly in the future. And one thing that we're really looking very, very seriously at is using some existing resilience standards for buildings. Fortified is one of those. I believe that's through, I'm going to get the acronym wrong. BG, you probably know it better. I think it's IBHS.
IBHS.
There we go. Okay, thank you. So with the insurance folks, so something that we could, if there's something already out there in the market that we could use and sort of lean on to further the understanding of what we're trying to do with resilience financing, that's what we're looking to do. So just a little teaser. I don't know, Brian or Mackie, if you guys want to add anything else here, but it's been an exciting challenge to start putting these guidelines together.
Yeah, no, thank you for that overview. I think one of the points of guidance that we provided in terms of that definition of resilience is, statutorily it's broad, but our mission is to confront climate change. So to the extent we can use our comprehensive plan and the statute to hone in on specifically, climate adaptation and resilience, as opposed to, any other sort of human-induced things, that was probably one guiding factor for us.
All right, great. Thank you. I don't think there's a resolution to approve on this one, so appreciate the update. I'd like to move on to an update and recommendations for our incentive programs, and starting with item A, which is the Smart E-Loan Linked Deposits Pilot. Brian?
Perfect. We'll turn it to Bert.
All right, thanks very much. I know we're short on time, but I do, for the benefit of newer directors, I'll point out that the Smart E-Loan product was approved by the board back in 2013. We just celebrated its 10th anniversary with a couple of lenders, which was really good. It's evolved into the Green Bank's flagship residential loan product offered through a network of credit unions, community banks, and a community development financial institution. This product is part of the Energize CT program, which we offer in partnership with Eversource, Avangrid, Connecticut Natural Gas, Southern Connecticut Gas, and it's done through a approved group of local lenders and contractors. So the program offers long-term low-interest financing from 4.49% for 5 years up to 6.99%. I think that's the standard 12-year rate. It helps homeowners upgrade their home's energy performance with no money down. Our role is we provide a loan loss reserve and product marketing, as well as contractor management, a lot of which is managed under a PSA with Inclusive Prosperity Capital. Since inception, our group of lenders have done over $110 million of loans, and our loan loss reserve has only been minimally hit, maybe about $300,000 over its 10-year history. So we're quite proud of that. Next slide, please. We did a roadshow with Inclusive Prosperity. Rudy Sturk, our director of marketing, we went out to talk to all of the lenders. And one of the things that the lenders are contending with is the increases in interest rates up from which the Fed has taken up by 500 basis points, 5% over 14 months. The Smart E program is based on a not to exceed series of rates that I mentioned to you. And so the banks and credit unions costs of funds have been increasing. It's not a uniform impact on their financing margin. It really depends on their mix of deposits between demand deposits, time deposits, and CDs that they have to offer. If you've been watching this space, know that there's been a lot of, since the fallout from Silicon Valley Bank, et cetera, there's been a lot of competition for deposits, which has caused some of these shifts to move around. They have a loan to deposits ratio. So typically banks and credit unions will stay in the 80 or 85% range of loans to deposits. Some institutions will be a bit lower, some will be a bit higher. And some of this is also related to business mix, whether they're focused on the commercial industrial space or more consumer space, and that'll have an impact on their margins as well. So this roadshow that we went on revealed one or two lenders of concern with net interest margin under particular pressure. One lender that we're dealing with, Mutual Security, indicated that they would have to suspend the Smart E-Loan product if we couldn't come to some kind of an approach. staff looked at the situation, we have been thinking about this for a while. We preferred not to solve a one or two institution issue with a blanket change in interest rates for the program. Those program rates have been very popular with homeowners and the program generally. So we came up with this concept of linked deposits, placing deposits with certain affected lenders at a concessional rate for a defined period, and that's what we're here to talk about today. Next slide, please. So how linked deposits work is whether it's a green bank, a government agency, or an impact investor, they'll have programs that are funded with loans, try to achieve outcomes that are sensitive to interest rates. The impact investor, as it were, will place funds on deposit with the program lender at a concessional rate, meaning lower than market. The rate that is chosen is somewhat flexible. It's determined to be the level at which a desired outcome is considered achievable. In this particular case, in discussions with a concerned lender, we agreed to a 3% margin below the Smart E yield is what we would deposit our funds for. That average Smart E yield is in the vicinity of 5.25%, which means that we would deposit at approximately 2.25% versus what we can get in market, it being at about 4.5% or so. In the pilot case, the cohort of loans that we're looking at is anything that was placed, that was funded by mutual security from January 1 of 2023. The end period would be June 30th of 24. The concession, however, would start about June 1 of this year. So in other words, we're funding from going back to January 1, but we're not going retroactively and giving a benefit for that the initial 5 months of the year. We're just starting from about June 1. We would do it for a deposit limit up to $2 million. The deposits would be returned to the Green Bank not later than 5 years from June of this year, which is about the average life of a Smarty loan. And the program can be terminated by the program lender at any time. The reason is if interest rates fall, this 2.25%, or in that vicinity, could actually be higher than what they need. Their balance on their balance sheet, loan to deposit ratio could change any number of reasons. We could extend the program beyond June of 24 for an additional year. We might change that margin at that time, or we may change how much we're willing to deposit, but that's up to the option of both parties, or we could end it. We expect the cost of this to be about $24,000 in year one, meaning for the next fiscal year, and for the life of the pilot, about $60,000, looking at a forecast of interest rates in line with what the Federal Reserve has is indicated is in their future by their dot plots, so-called dot plot forecasts of interest rates. So that's the outline of the pilot, and you have in your package the specific terms and conditions, but they're pretty much outlined here. Happy to take any questions from the committee.
So we're giving them, what exactly are we giving them? The 300 basis points?
Correct. In other words, we would look on a monthly basis the yield on this cohort of loans, the cohort being determined as loans that they funded from January 1 of this year forward. And we'll look at what that average yield is. And so every month, this money market deposit would adjust upwards or downwards, depending upon that yield less 300 basis points. So currently it's about 5.25% their yield. So to us, we would get 2.25%.
Okay. And of course, if rates go lower, it has less of an impact to us.
Correct.
Okay. But the max would be 300 basis points.
Correct.
Okay. And do they
Bert,
like
it's your-
that rate? Do they like that spread, that margin?
That was negotiated with them, yes.
Okay.
I'm sorry, there was another question.
In the bullet points, Bert, the third from the bottom, terminated by the program lender. Is that the bank or us? Sorry.
Yeah, sorry, that would be the bank. Yeah, the credit union in this case.
Okay, so if the rates fall, they could terminate it. But it's really, doesn't it benefit them to, I mean, we're like a insurance policy for them, aren't we?
Yeah.
Correct. But if interest rates should precipitously fall,
Yeah.
you know, they could say, hey, look, yeah, Green Bank, would you please take back your deposit? Right.
Okay.
We don't want to pay you 2.25% anymore. So
All right.
if you know.
Got it. And the pilot period is how many years?
The pilot period is just for the cohort of loans from January 1 of 23 to June 30th of 2024. And it would be, we would look at it in a year's time and see if we want to extend it for a further year.
I'll just say in some years ago, the Green Bank always had the problem, or previous entities, where we'd get into a problem like this and our programs would like disappear for a while. And it was really confusing to the market. So I think it's a great solution, Bert, to keep continuity of the program over a rough patch and not have to have customers wonder what happened to the loan and then it comes back. So.
Thank you.
Yeah, clever. So you made an estimate on how many loans would be entered into for the next 12, 13 months to come up with
Yeah,
that
that's
60,000 total?
correct. That's in your package. It's outlined there. I think it's Appendix B.
Appendix B.
Appendix B. Yeah, so it has for the first year, we're just saying consider that they would do up to $2 million through June of 24, and that by June of 25, if we extended it, that it would be another $1.6 million of loans. They've generally done about $1.2 million of loans per year, so we just upped it a little bit, and then we looked at stopping it, and then of course the portfolio kind of goes down over time.
Okay, I see it.
Last question, and the extension would come back to us if there's going to be an extension, right? Or we'd get to look at it.
Correct. Yeah.
Thank you.
We're at 309.
Okay.
Oh.
Is there a motion to approve? Resolution number 9.
Bettina, I'll move it.
All right. Is there a second?
I'll second. This is Dominic, just to mix it up.
Thank you. All in favor?
Aye.
Any opposition? Any abstentions? All right, the motion is approved. And so we're moving on to the final resolution number 10. And that's going to be related to a discussion of the Smarty loan program and expansion to include environmental infrastructure measures. I'll turn it over to Ashley and Brian.
Excellent. So Ashley, Stewart, and myself are going to tag team on this proposal. I'll tee it up and then turn it over to Ashley. You might recall, or some of you might recall, back in November of last year, we brought forward a set of recommendations to increase the number of measures for the Smarty loan for climate adaptation and resilience measures. Today, we'll be bringing forward some recommendations for water measures, and these are all consistent with our broader new statutory authority along the lines of environmental infrastructure. So last time we approved of climate adaptation and resiliency measures that would be included as eligible improvements within the Smarty loan. We also wanted to seek a gold star standard. You all might remember that there was a recommendation from Dr. Rebecca French at DEEP to pursue a FEMA review of that list. We've got confirmation from our Department of Insurance colleagues that FEMA has reviewed and given a thumbs up on that list. So that's great. We also noted a review and approval of additional environmental infrastructure measures for consideration would come at a future date. So that's what we're going to be spending our time on today. But then just note that before we can do any of this, that we have to seek review and approval of a plan for how we roll out environmental infrastructure measures. And that would include a number of different things. But we're thinking about in FY24, how would, even though we have these measures, how would this actually roll out? So we'd have to come back to you for that. So just wanted to set that context, and let me turn it to Ashley Stewart to take us from here. Ashley.
Thank you. Thank you for reviewing and including this action within today's agenda. My name is Ashley Stewart. I'm the Manager of Community Engagement and been supporting the Green Bank in the scope expansion in environmental infrastructure. So on July 6, 2021, Governor Lamont signed Public Act 21-115, an act concerning climate change adaptation, into law. As a result, the Green Bank and I started a robust stakeholder engagement process to better understand the opportunities within the expanded scope and where the Green Bank's tools can enhance public policy to reach our climate hopes for the state of Connecticut. One aspect of that process was to evaluate the suitability of expanding existing program offerings to address environmental infrastructure. Last November, you all voted to expand our homeowner loan product, Smarty, for resilience measures. And today I want to present a priority list of Smarty additions that focus on water. We partnered with Quantified Ventures to develop and research these measures and sought and receive feedback on the developed list from Connecticut DEP and DPH staff. We aligned our measures with goals listed in the state water plan and DPH and DEP's water management goals. Some of the affirmative feedback we received from DPH's support was DPH's support and enthusiasm about the septic measure. They offered to add the Smarty loan to their list of financial assistance programs on their website and would want to share this expansion, if approved, with local health departments. We also worked with DEP to include measures that would enhance their efforts to support environmental justice communities. Included in the list is the sewer backflow prevention measure to support homeowners in combined sewer overflow areas that are experiencing sewage and stormwater backflow into their homes. So this list of 9 measures covers resilience areas around water and energy efficiency, flood and stormwater management, water quality, health impacts, climate resilience, and mitigation of extreme heat. On the next slide, I've highlighted 5 priority measures that display the range of the proposed list of measures. So going through them really quickly, sorry. The first that I listed is upgrade appliances. The intention of this measure is to reduce water use. This measure is a natural fit for the Smarty loan and would be bundled with other measures or together. The second, in blue, is replacing or upgrading on-site septic systems. There's a need for financial support to homeowners in maintaining on-site systems, evaluating systems in light of climate impacts, like rising groundwater levels or connecting homes to public treatment systems. The third, in red, is to replace lead service lines. This measure is a priority for water utilities and for EPA. Every home in the state should be able to replace lead and copper service lines, and including this into Smarty will make the transition for small water supply communities and homeowners internal fixtures and piping more feasible. In orange, the example is installing sewer backflow. This action came from the collaboration with Connecticut DEP. The goal is to give homeowners another resource to address sewer backflows with specific interest in supporting the north end of Hartford's homeowners that have been experiencing this over the past year. This measure can help any homeowner become more resilient to increased storm intensity and provide flood protection in CSO areas. And the last, dam maintenance and replacement. This is a unique measure that focuses on providing financial option for private homeowners that own dams to keep them maintained, inspected, and even to evaluate the possibility of removal. There is no other resource like this in the state, and I'm excited to support dam infrastructure across the state through this proposed expansion. So there are a total of 9 proposed measures. This is 5 of them. And because we're already over time, I'm just going to say thank you for giving us time. And yeah.
Fantastic. Thank you, Ashley.
Thank you, Ashley.
Comments?
Brian, it's Matt. I know we only have a little time, so before I comment, what is there a resolution, or are we just getting an update here?
Resolution number 10.
Okay.
Yep.
So Ashley, thanks. It's a great list, a lot of work and effort. I do have some questions and concerns, especially about the replace and upgrade private septic systems and dam maintenance. My concerns aren't that those are good things, but those are can be very complicated systems and undertakings, especially the dam issues because of sediment and contaminated soils. And I don't know, given the time we have, I honestly don't know if there's enough time to really unpack all that. I don't want to eat up the whole time, but and the other 2 concerns I have are just making sure that as we go forward with Smart E, that we understand whether the people taking the loan would be subject to different building code standards because they're accepting state aid. Because there are some, for especially flood impacted areas, there's 2 sets of standards, and 2, making sure we have the right protections in place, that we get what we're paying for from contractors. A lot of these smaller projects, they don't have, we probably want to make sure there are formal contracts to require them to achieve certain specifications. So we're not spending money and not getting the results for the program.
One thought, Matt, I had, so the resolution we had was a continuation of last time. Here are some measures. You still have to come back before the program is reviewed and approved. This doesn't have that gold star resolution, but maybe we would consider something like you have so much experience, Matt, in land use and in all these different things, that there's a part of me that wants to say, let's have a meeting with the relevant agencies, DPH, maybe others, and just kind of go through the measures that are on the table and ask those pointed questions like you just had, building codes. Like no one on our team is going to have that level of touch point, that I think it would be important to have that conversation. It will just be helpful to us. So I'm wondering if we could add that piece in to get you more comfortable. But ultimately we have to come back to this committee before anything can be rolled out.
Yeah, if we have to come back, I'm fine with that, and I would be happy to attend any of those meetings, Brian.
Cool.
Can I add one more thing? Part of talking with DPH and DEP was to DEPH has a list of contractors that are approved to repair septic systems, and making sure that we align with that through our Smarty loan is going to be pretty important. I think because of your comments about how technical and specific those needs are, but also that this potential support for dams would include the engineering costs to evaluate the project and its needs. But those are the 2 responses to your comments.
This is Lonnie, just sort of building on that, and Ash, this was incredible work that you've done. I mean, a lot of this is really old infrastructure begging for attention for years. But just to know where the blowback might come from, I mean, I always like to collect that stuff way ahead of time, get out in front of it, anticipate it, kind of know who's going to give us the pushback. Would be a really good thing, I think, as we move forward.
This is Bettina. I thought I agree with Matt. This is a lot to unpack. There's a lot here. I thought the lead lines, I thought there was federal money coming in for that. And also can you go back to the slide before the stormwater stuff backups? I think that's a program that DEEP is actually working on funding for some of the sewage backups. So I'm just wondering if some of the stuff isn't already being addressed elsewhere.
Yeah, that's why it was important for us to collaborate with DPH and DEP
Yeah.
because we didn't want to be redundant.
Yeah.
For the lead service lines, there is an overlap because most of the federal funding is coming to the water utilities. So the Regional Water Authority, MDC, and there are homeowners that are not under any of their authority. And there is some responsibility for the homeowner to change over their own fixtures, any internal piping. The utility has a limit to how far they go. So,
and this is Lonnie just saying exactly that. And that, that has been an issue for several years of where the homeowner's obligation begins and the battles that go on of, how far the utility is responsible for, and when the homeowner has to step in, and now they're his pipes or her pipes.
So what is the actual, what's the resolution that you're asking us?
There you go. So let me propose an addition. So the resolution would be to support these measures as consistent with, the statute. But ultimately we'd have to come back to the deployment committee for the full program. But what I'm suggesting is an inclusion, probably like in between the second and third one here. That would be something like resolved that the Green Bank staff would engage members of the board and deployment committee with state agency staff to understand linkages between measures, policies, regulations, and other relevant features. And I think what that would do is it would create a space for experts like Matt who understand the nuances here to push our state agency colleagues to dig a little deeper on how we think about financing the measures.
That makes me much more comfortable, Brian, because of course the state in conjunction with DEEP runs the state revolving fund, which is the clean water and drinking water programs. And, we have expertise along with DEEP in that front as well. So I'd like to have our program manager participate in any discussions as well where we can be helpful.
Perfect. So I've got DEEP, DPH, and Office of the Treasurer. There might be others, but we'd start there.
Great. Good.
That would be the proposal, Chair Webster.
Yep. So with that amended language, do we have a motion for approval?
This is Dominic, so moved.
Is there a second?
Matt,
this is Lonnie. I second. Oh, go ahead, Matt.
I've had my share, Lonnie.
The big dog. No, Matt, you go. This is your this is your lane.
We'll give one of you a third. All in favor, say aye, please.
Aye.
Aye.
Any opposed? Any abstentions? The motion carries. Thank you. And with that, we move to our final agenda item, just other business. Is there anything that anyone wants to raise? Hearing none. All right, thank you. Then I will ask for a motion to adjourn.
So moved, Lonnie.
Second.
We'll split it.
All right. All in favor?
Aye.
Aye.
All right. Hopefully nobody's opposed. No abstentions. Thank you all. I know we covered a lot of ground on this call, but appreciate the input and the feedback and the engagement. And with that, I don't know if there's anything else to do, Brian, other than hit the leave button, but
Thank you very much.
Thank you.
Thank you, Hank. Bye-bye.
Thanks, everybody.
Thank you.
Bye.
Yeah.